From Bloomberg World Headquarters in New York to our TV and radio audiences worldwide, welcome to Balance of Power, where the world of politics meets the world of business. I'm David Weston. We start with a check on the markets, and joining us today is Kriti Gupta. She's Bloomberg cross-asset reporter. So we have to start with the markets, Kriti, given what happened yesterday, because it was pretty dramatic.
Absolutely, David. Let's just start off broad. Let's start off with the S&P 500. You're actually seeing it in the green, meandering a little bit with those tech gains, and that really has to bring me to the NASDAQ 100. That really tells you that that tech bounce, that tech underperformance yesterday, turning into tech outperformance today. Crude also pulling back a little bit, not in line with that risk sentiment, but that could change next week. That's probably reacting to a little bit of a bid for the dollar. The real action, though, David, like you mentioned, is in that bond market, specifically in the 5-year yield. You're already seeing the 5-year cross back to where it closed on yesterday's levels. And here's why the 5-year yield is so important, David. If you actually look a little bit broadly to all the maturities, the 2s, the 5s, the 10s, the 30s, you're really seeing the belly of the curve get a lot of that price action. And that's important for things like mortgage rate convexity. Now, that's a lot of jargon for simply saying that there's a lot going on in the bonds market, and it's starting to impact other things like the corporate credit market and, like I mentioned, those mortgage rates, David.
Okay, thank you so much to Bloomberg's cross-asset reporter, Kriti Gupta. Well, that dramatic spike in the 10-year yield as well as the 5-year yesterday comes against the backdrop of increasing talk about possible reflation or even inflation. For a read on the economy and the state of the recovery at this point, we welcome now Ellen Hughes-Cromwick, Third Way Senior Resident Fellow. Ms. Hughes-Cromwick earlier served as the Chief Economist at the Department of Commerce and at the Ford Motor Company. So welcome, Ellen. It's always great to have you with us. And I think a lot of people looked at yesterday at least and said, is this technical? Is it something going on within the bond market? Or is it really an indication of how fast we think the economy may be coming back?
I think it does show that investors are expecting that we've got a ton of pent-up demand and consumers have the wallet to spend. And so, this is really not unusual. When you look at the curve, especially 2s to 10s, which to me is a really important study, you typically see that spread widen out substantially in the early part of a recovery. And I think that the market is kind of telling us that. So to me, it's a really normal kind of backup on the long end of the curve. The 2-year is, obviously much more anchored to the Fed policy rate. But this sort of spread widening happens at the beginning of a recovery. In fact, the average 2s to 10s spread is over 200 basis points. Today, it's like 130 basis points.
So, Ellen, just I think to confirm what you're talking about here, we got some economic data out, as you know, this morning. And personal income was up 10%, more than anybody thought it would be. Consumer spending up 2.4%. And I understand savings is up 20% because people are saving a lot, too. Is there really, are we building up here a pent-up demand, essentially, where when we come back, actually, as we all hope to soon from this pandemic, there's going to be a real flood of money into the economy?
I think that's absolutely right. And I think what investors and what the rest of us out here on Main Street are trying to understand is what is the timing of that? And that's why the stimulus package is so critical today, because we want to make sure that this happens as we get COVID under control. The stimulus package has a lot of features in it to make sure that COVID doesn't get in the way of people's lives and livelihoods as we see the vaccine roll out. And it really is now. I mean, it is amazing what has been accomplished in the last, 30 or so days. So I think it is that, really that we're going to see that money unleash and people are going to go out and they're going to want to spend.
So is there a danger here of overshooting the mark, though? Because we are told that as much as $1 trillion still hasn't been dispersed of the stimulus that's already been approved. We're not talking about another $1.9 trillion. Are we sure we're not actually overshooting the mark? Could we really trigger an inflation that, as you know so well, is hard to get your arms around once it gets going?
I don't think that it's too much. And, furthermore, Chair Powell told us he doesn't think it's too much. Secretary Yellen told us she doesn't think it's too much. We have a lot of people, a lot of experts saying, we have to go big. And I think that's super important right now that we do, really make sure we take out an insurance policy. We can always roll back and modify as time goes on. But right now, let's focus on getting COVID under control. And this package really does that. You know, you had Representative Kildee on yesterday, which I thought was fantastic because he started talking about, well, what's the next step? And for a sustained recovery, getting an infrastructure package is going to be critical. And clean energy will create jobs. We heard Secretary Granholm talk this morning about clean energy jobs. Here in Michigan, we're going to see a lot of those jobs with EVs and moving to retooling our plants.
Well, I'm glad you talked about that because you know an awful lot about electric vehicles, and we're told we're heading in that direction very fast. I mean, you talked to Mary Barra at General Motors, and she really has very ambitious goals. Can we accomplish those goals, both in terms of trained employees, people who can work in this new sector of electric vehicles, and also in terms of raw materials, things like lithium?
I mean, absolutely. I'm sure you saw the GM commercial at the Super Bowl, Will Ferrell. I mean, Norway, we're going to let these other countries outcompete us? No, it won't happen. As you know, in Michigan, we have so much talent here. The union workforce, the engineers at the companies. We've got dozens of R&D facilities, including Rivian, which is located here and doing all of the ramp up as they get ready to launch their electric pickup in Illinois. So I think there's a lot to be done. Yesterday, I was looking at all the plants and the number of workers that we have here, and there's so much capability to make that conversion to electric vehicles. We know how to do it. You know, we know how to run things and organize things.
So, Ellen, you referred to Chair Powell in his testimony this week in front of Congress, both the House and the Senate. And as you say, he said, look, this is a positive indication what we're seeing with the yield curve, but it was a very different yield of the 10-year when he was testifying. Do you think he'd give that same testimony today? Do you think there's any thought in the Fed's mind that this might get out of control and we might have to intervene?
Well, hopefully his rudder is a little more stable than 48 hours. I mean, we need to have a Fed that runs the course with a strategy. They introduced a new framework that we've had plenty of time for financial market participants to digest that. What does it mean? Why did he say it? And I'm hoping that, 48 hours isn't going to generate some reaction. He really laid out with his colleagues at the Fed why we need to have periods of inflation overshoot. I mean, we haven't had 2% inflation in decades. People forget. I know bond market participants are really cued in, but I bet there's a lot of people in the bond market today that don't remember even a time when we had consistently 2% inflation. So no, I don't think he's going to shift. This is a rudder. It's in the water. And they've got to stay the course and stay over the keel. I mean, that's my view.
So, Ellen, finally here, you're an economist. You're not an investment advisor. But I have to say, given what you just said, does it make any sense right now to be investing in fixed income?
Well, you're absolutely right, David. I don't want to give investment advice. I'm not a financial planner or a financial advisor. I can tell you from my end, I'm very bullish about the long run outcome with regard to the U.S. economy and making this transition to cleaner energy. I think there are going to be tremendous investment opportunities. I'd be buying green bonds. That's where I would go. There's a lot of opportunity in the green bond market, and it's going to grow substantially.
There you go. Thank you. It's really always a pleasure to have you with us. That's Ellen Hughes-Cromwick. She's Third Way Senior Resident Fellow. And a programming note now, Wall Street Week will air tonight at 6 p.m. Eastern Time. Larry Summers, Ruchir Sharma, Peter Krause, and Gillian Tett are among our guests. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we go now to Mark Crumpton.
David, thank you. President Biden takes his first trip to a major disaster site since he took office. Texas was hard hit by the energy crisis earlier this month, prompted by the extreme cold weather. In Houston, the president has two missions. He's looking at damage caused by severe winter weather. He's also encouraging people to get their coronavirus vaccine. Today, a panel of FDA advisors is taking a close look at Johnson & Johnson's coronavirus vaccine. That's one of the final steps toward possible authorization of the country's first one-dose immunization against the virus. The FDA could grant emergency clearance within days. This weekend, Donald Trump will declare himself to still be the leader of the Republican Party. On Sunday in Florida, the former president will speak to a conservative group. A senior advisor says he's unlikely to say whether he'll run for president again in 2024, but he's expected to boast he crushed opposition within the Republican Party. Most Americans are likely one step closer to receiving $1,400 relief payments. The House is expected to pass President Biden's $1.9 trillion stimulus package. But the final legislation probably won't include a raise in the minimum wage to $15 an hour. The Senate parliamentarian ruled yesterday the wage hike couldn't be considered under the same fast-track rules. Democrats are using them to push the stimulus through Congress. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thank you so much, Mark. Well, Mark just talked about it, that stimulus package. The House of Representatives is due to vote on that $1.9 trillion package tonight. Even as part of the package, that $15 minimum wage remains very much in doubt. To give us the current state of the play, welcome now our chief Washington correspondent, Kevin Cirilli. So, Kevin, we got both the House voting on the stimulus, but also some, can I call them shenanigans maybe going on over on the Senate side with Senator Schumer?
How about we call her the political referee? The Senate parliamentarian Elizabeth McDonough has ruled against being able to include the $15 per hour minimum wage, that it goes against reconciliation rules. I will get out of the political wonk weeds for a second and give it to you straight here. It essentially means it's not going to be in the Senate version of the bill. And the Biden administration is forecasting that they're going to be okay with that. So this is actually likely going to make it a lot easier for the stimulus bill to end up on President Biden's desk in the next 2 weeks to get this thing signed. It's not the end of the debate over minimum wage. People like Senators Kyrsten Sinema of Arizona and Joe Manchin of West Virginia, two centrist Democrats, have come out and said they were not in support of this minimum wage in the Senate bill, but they are going to likely have this debate in a couple of months. And then we open the door for, get this, raising the corporate tax rate. A lot ahead.
Now you're talking, no question about it. Thank you so much to Kevin Cirilli. He's our chief Washington correspondent, and you want to make sure that you catch his interview tonight with Transportation Secretary Pete Buttigieg. That's on Sound On, Kevin's program on radio at 5 p.m. Eastern Time. The politics surrounding the $15 minimum wage are very uncertain, as we just heard. But what about the economics? Bloomberg editor-in-chief emeritus Matt Winkler has taken a look and presents his conclusions in a piece today on the Bloomberg, and we welcome him now. Matt, terrific to have you. I guess, in a nutshell, you say the pandemic and what happened to employment is actually sort of a test case on what might happen with minimum wage.
David, it's great to be with you, and on this subject especially. And that's because, as you just said, if you looked at the 2020 year of the pandemic, we had horrendous unemployment, almost 15%, last seen really in the Great Depression of the 30s. And that would have been the ideal test case for all these states that since 2016 raised the minimum wage. And in fact, when we look at our data on Bloomberg, and we can look at all 50 states, and we can look at personal income and employment and GDP per capita, and the states, the 29 states that raised the minimum wage or committed to it since 2016, really substantially outperformed the states, 21 of them, that resisted doing so and essentially are abiding by the very low federal minimum wage that's below $8. So what that tells us is that actually raising the minimum wage to $15 an hour is benign for business and labor alike. And, this has been, as you say, a historic debate between liberals and conservatives, but it really shouldn't be, because if you look at the economics, both capital and labor here have benefited from increasing the minimum wage. And we know that because we look at the performance of these states that I'm talking about. And 2020 really was the best way to look at it, I guess, because that's where you would have seen a dramatic divergence in job growth.
To be fair to the conservative side of the argument, as I understand it, they don't question that, in fact, people make more money when you raise the minimum wage, or in fact that it may be good for the economy in the sense that GDP grows. The question is, do you actually eliminate jobs as well? As you know, there are various congressional budget office studies come out and say, look, you increase people above the poverty line overall, but you also eliminate perhaps as many as 1.3 or 1.4 million jobs. What do you make of that? We may be good for the economy, but not for 1.3 million people who lose their jobs.
Well, David, based on data compiled by Bloomberg, if you look at the 4-year period from 2016 until 2020, the states that increased the minimum wage actually outperformed the states that resisted doing so in job growth, just that category alone. We'll leave the others aside. So you get to 2020, that's the only year where some of the states that resisted raising the minimum wage pulled ahead in, it wasn't really job growth. They just didn't lose as many jobs. But that happened in large part because we were in a shutdown. And so many, for example, retail industries that are really catering to the minimum wage crowd were the ones that were victimized the most. So the data that we have from the states themselves suggests that that's not really true anymore, if it ever was true.
So fair enough. You can't argue with data. No question about that. But what about other unintended consequences potentially? We talked with Larry Summers. As you know, he contributes to Wall Street Week all the time. We talked to him last week about this, and he said he wasn't so concerned about the job elimination as he was about things like benefits. This is part of what he had to say.
I worry that employers will stop paying benefits when they have to pay higher wages. I worry that employers will shift away from the most vulnerable and inexperienced workers towards workers with more experience and more education. And so I think I'd probably prefer to see a more gradual approach and a more differentiated approach.
So you notice there, Matt, he wasn't saying we should not, Matt, he was not saying that, in fact, we shouldn't be increasing the minimum wage. He was saying that maybe it should be more gradual and more differentiated. And now I'm not sure that the Bloomberg has the data on those possibilities, but what do you make of that?
Well, everybody has this data. Unlike white guys like you, me, and Larry Summers, David, women, African Americans, and Latinos historically are in the poverty category, okay? And they were the biggest victims in 2020, and they've historically been the least compensated. So what raising the minimum wage is going to do is substantial for women, African Americans, and Latinos alone. But, everybody's going to benefit. I mean, look, if we get to a point where we actually think it's a good idea for people to have a living wage and not to be in poverty, then we're going to be thinking about those other concerns that he has and address them as well.
There's also, it strikes me, Matt, sort of, if I forgive the expression, a federal issue here, because as you point out, a lot of states have gone along on their own, just for their states, and increased the minimum wage, many to $15, maybe over time. Is there an issue here about states competing with each other over wages, and is that something we want in our economy?
Well, yeah, probably want states to drive up benefits, drive up compensation as much as possible, because we have such great inequality in this economy. And it's been, unfortunately, for the past several decades, favoring the rich. People like you and me don't have to worry, but most people do have to worry paycheck to paycheck. So this is a very big issue for this country, and we're kind of behind relative to our peers in the developed world on this one.
Should we be considering differentiation according to cost of living across the country?
Oh, I don't know if that really, it's a global economy, and I suppose certain parts of the country have diverged from other parts. But overall, there's a reason why Amazon decided everybody who works for Amazon, whether they're in Seattle, Washington, or New Jersey, or down south, wherever, they're all going to get the same pay, and they should. And Costco, by the way, just I think yesterday said it was going to raise the minimum wage. And Walmart is even doing something about that, too, belatedly. So all of these companies have recognized this.
Yeah, it's a fair point without any cost of living adjustments. Thank you so much. It's always great to have you with us. That's Bloomberg Editor-in-Chief Emeritus Matt Winkler. And a programming note, Wall Street Week will air tonight at 6 p.m. Eastern Time with more from Larry Summers, as well as Rushir Sharma, Peter Krause, and Jillian Tatt. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. DraftKings is our stock of the hour, rising today on its strong forecast as sports come back into arenas across the United States of America. Emma Chandra is here with the story. So, Emma, should I go start betting on sports? Is that what I should do?
Probably. It seems that DraftKings expects more people to do that. Exactly. Seeing a nice pop for the stock today, up around 7%. Why do investors like it? Well, it's all about the guidance. DraftKings coming out and saying that they expect their revenue to be a lot better than they had been initially saying for 2021. They raised guidance. They expect it to be somewhere between 900 million and 1 billion in revenue in 2021. And that would mark some sort of 40 to 55% increase on last year. So investors, of course, liking that, pretty significant numbers. What are the reasons? Well, three things. One, of course, perhaps the return of live sport. A lot of live sport having been cancelled over the past year. Baked into that guidance, DraftKings saying they expect all those announced calendars for both professional and college sports to go ahead. Of course, March Madness due to start next month. The second thing, of course, David, is more people seem to be willing to bet. They've been adding the number of monthly users up some 50% in 2020, and they're willing to spend more. And finally, David, and perhaps most interesting to your show, is the political tailwind. Of course, more states looking to allow sports betting. Currently, about 21 states allowing that. 6 more have agreed but are building the apparatus, and 10 others have a scheduled vote or debate on the subject, David. Yeah,
at a time when the states really need the money, the tax revenues right now, so they have an inclination in that direction. Thank you so much to Emma Chandra. And later, DraftKings CEO Jason Robbins joins Bloomberg Technology. That's coming at 5 p.m. Eastern Time. Coming up, Richard Trumka, president of the AFL-CIO, on the stimulus package and the fight over that $15 minimum wage. We're going to ask him how important it is to his workers. This is Balance of Power, and we're on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we go now to Mark Crumpton.
David, late yesterday, the United States carried out airstrikes in eastern Syria. The bombings represent President Biden's first overt use of military force since taking office. The targets are connected to Iran-backed groups. They're believed to be involved in recent rocket attacks on American forces in Iraq. The Pentagon says multiple facilities were destroyed. The European Union's being warned that it should support vaccine passports to help countries to reopen to travel. EU President Ursula von der Leyen says that unless the bloc hurries, Apple and Google will step into the vacuum. She says the tech giants are in talks with the World Health Organization about some sort of vaccine certificate. It's another big challenge to an economy already rocked by Brexit and the coronavirus. Foreign workers are leaving the UK at the fastest pace since World War II. Recent research suggests over the last year, London alone has lost 700,000 people. The implications are huge for the Treasury, landlords, and the chances for an economic recovery. The House is expected to approve today President Biden's $1.9 trillion coronavirus relief bill. That will bring most Americans one step closer to receiving $1,400 payments, but it's unlikely the measure will include an increase in the minimum wage to $15 an hour. The Senate parliamentarian ruled that it can't be considered under the fast-track procedure. It's being used to push the stimulus package through Congress. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thanks so much, Mark. We want to pick up exactly where Mark left off with that $1.9 trillion stimulus package. Expect to make it out of the House of Representatives today, but maybe without the minimum wage, the $15 minimum wage. For more on this, we welcome now AFL-CIO President Richard Trumka. So, Richard, always great to talk with you. Let's start with that $15 minimum wage. How important is it to the stimulus package?
Well, it's not just important to the stimulus package. It's important to America. Look, regardless of the parliamentarians' ruling, David, the fact remains that workers deserve a raise. If the minimum wage had kept up with inflation, it would be $24 an hour right now. The minimum wage hasn't been raised since in 12 years, since 2009, and it's still stuck at $7.25 an hour. If you increased it, the $15 would have benefited 27 million workers. It would have pumped up the economy. It would have reduced poverty, and it would ensure that working families have a little bit of economic security that they absolutely deserve. So we're going to get it done one way or the other. The easy way or the hard way, we'll get it done.
Richard, you know the worker better than anybody else I know. You have 12.5 million, more or less, workers that you represent. What do you say to the argument? And basically, one of our viewers actually has already written in saying, wait a second, if you go to $15, you may bring a lot of people above the poverty level, which is a good thing. But you're also going to have a lot of people lose their jobs as people basically, employers cut back on their employment or cut back on their hours. As you know, there are some studies that suggest that. Are you worried about that and even pushing companies toward automation?
Well, look, David, that's sort of a red herring. We've increased the minimum wage multiple times, dozens of times. And every time we go to increase the minimum wage, it's the same argument. It's going to decrease jobs. It hasn't decreased jobs. Listen, if you're going to increase the wages of 27 million people, they're going to buy things. And when they buy things, that creates demand. And that demand is going to create jobs, not do away with jobs. So that's a red herring argument as far as we're concerned.
Richard, you have this little thing called the parliamentarian in the Senate you have to get passed because she ruled yesterday that you cannot do this as part of budget reconciliation. Is that basically take it off the table? We now hear reports that maybe Senator Schumer, the majority leader, is suggesting maybe there's a way to do this through taxation of companies who don't pay as much as $15 an hour.
Look, whatever it takes, working Americans and our members expect Congress to get this done. And I'm glad to see that Leader Schumer is thinking creatively because despite an archaic rule and a bad ruling by the parliamentarian, this must get done for the economy, for the working people that are out there, and to reduce poverty. So whichever way it gets done, we'll do it, whatever it takes, but it is going to get done. It has tremendous support among the general population, David. 70-some% of the people out there support an increase in the minimum wage. As I said earlier, it hasn't been increased in 12 years. It's stuck at $7.25 an hour. Nobody should have to work 40 hours a week and still live in poverty. That should not be happening in the United States of America.
So the House is due to vote on this tonight, and as of right now, it looks like probably they'll pass something very close to what the president proposed originally with the $1.9 trillion. Then it goes to the Senate. Put aside for a moment the $15 minimum wage. What do you expect to come out of the Senate? You don't think it's really going to go through just as written, do you?
I think it can actually get improved a bit because the health care subsidy right now for COBRA benefits is at 85%. And our experience has been, even if it were 90%, people that have been laid off, particularly for a long period of time, can't afford to buy that COBRA. So you have millions of people without health care right now. We would like to see it increase to 100%, and that would take the scoring from $8.7 billion to $10 billion. In a $2 trillion bill, that's almost it's not even noticeable. And the other thing is, you're giving a lot of money to a lot of people, but we haven't given much to health care. It's time that the health care of those workers, especially those essential workers, especially people of color, especially women who have been denied that health care, should have it restored right now, especially during a pandemic.
Richard, we've talked to several lawmakers on the Republican side of the aisle, and pretty universally, they say a couple things that I want you to have the opportunity to respond to. Number one, we don't need to do this right now because there's $1 trillion that's been appropriated already that hasn't been dispersed for stimulus. That's coming down the pike. And number two, so much of this is not related directly to COVID. I mean, unlike the COBRA, which I understand that is directly related, the testing and the vaccinations, but a lot of it isn't. What do you say to those two arguments?
Well, first of all, the second argument is just flat wrong because this stuff is related to COVID. You're given state and local aid. State and local governments have been hit hard because of COVID. They've had their revenue reduced. So public services like health care, public safety, and sanitation are threatened. Education. We must do more to open up our schools and get them back. That takes additional funding that we don't have, and the school districts have been hit hard because of COVID, and they can't get it. Building capacity to fight the virus itself, that's a direct thing with COVID. Multi-employer pension relief. Our pension plan has been in crisis for a long time. The COVID disaster and crisis right now has pushed it to the brink of failure. It needed help. We've helped corporations. We've helped other people. We need to help pension plans. The same with transportation. And the last one is the health care subsidy that I just talked about. 85% of COBRA is not enough. We need to take that up to 100% of COBRA so that the millions of people that have lost their health care because of the pandemic and the loss of work because of the pandemic can have health care back.
Richard, it's always valuable to get your point of view on these important subjects. Thanks so much to AFL-CIO President Richard Trumka. Coming up, we talk with Valley National Bancorp CEO Ira Robbins about what the stimulus bill and the surge in bond yields could mean for his business. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. The Payroll Protection Program has been a key element of fiscal stimulus, getting money to small businesses who really need it. And regional banks like Valley National Bancorp are on the front lines in implementing that program. Welcome now the CEO. He is Ira Robbins. So great to have you with us. Thank you. Tell us about what your experience has been with the PPP. Where is it now? Where is it going?
So just going to give you a bit of background. Valley's about a $40 billion bank. We have about 1 million customers, largely in New York, New Jersey, and Florida. In the first round of PPP, we did about $2.3 billion and impact about 13,000 individual businesses. We're seeing in this round today about 45% of the people that came to us for first round have now come back for a second round of stimulus. And the needs definitely seems to be targeted towards a few specific industries versus in the initial round, which was obviously much more broader. So the demand isn't nearly what it once was, but for those that are in specific industries, there is a significant need still for it.
Is the money, in your experience, going to the really small businesses? There was some concern it was not getting there. It was going to bigger businesses. And as you know, they essentially suspended the program for anybody over 20 employees for 2 weeks.
Yeah, it's an interesting topic, right? And I think what President Biden's done has been positive from a PR perspective, but in reality, I think it's more focused on priority and eligibility. And those weren't the issues initially for some of the minority-owned businesses. In the first round, 30% of the loans that Valley did were to minority-owned businesses and to women-owned businesses. And their eligibility was never the issue. It was the fact that they needed somebody to help walk them through the process. They were overwhelmed by what that challenge was. And we still see that to be the challenge today. So changing the eligibility, changing the prioritization, great things. But those aren't the hindrances that have really stopped small businesses from going after the PPP. So we think the direct approach, a relationship bank like Valley, being able to walk some of these individual businesses through is the correct approach. And this is how we provide access to them. It's not necessarily just changing the eligibility.
Ira, one advantage of talking to you is that you are a regional bank. You deal with real people, real small businesses. But at the same time, you're not just a local bank. You have operations in New Jersey, New York, but also, for example, in Florida. So you get some sense of how it's working around the country. We heard from Jay Powell, the Fed chair this week, basically saying the recovery is different in different places. What's your experience?
Yeah, I think it's different to different industries as well as it's different to different geographies. Just as an example, if we use PPP, it's about 20% greater people in New York and New Jersey looking for a second round of PPP than what are looking for it in Florida. So the economic recovery in Florida, just based on purely on PPP, would imply that it's been a much stronger economic recovery in that geography. And we can see firsthand the number of people that are actually moving from up here in New York and New Jersey down to Florida, and that's having a positive impact on the economy there as well. So it is going to be different recovery times for each individual geography, just like there's going to be different recovery times for some of the individual businesses.
As you know very well, we saw a dramatic move in the yield curve on government bonds yesterday. Give us a sense from your point of view, running a bank, does that change your business at all?
Interestingly, we talked a lot about it this morning. We are a spread bank, so about 85% of our revenue is based off of what we make on our loans versus what we pay on deposits. So the yield curve is extremely important. We're looking at what the impact is on the mortgage business that we do. We do about $2 billion a year of residential loans. So whether they're going to continue from a refinancing perspective. So the long end movement has definitely begun to have an impact on that. That said, we're still seeing significant activity from a refinance perspective as well as from a purchase mortgage. I do think the disconnect, though, between the short end and the long end is something to be concerned about, and whether it's really fear that's driving the back end of the curve as we think about inflation. If you compare it to some of the other global indexes, we seem to be very disconnected from our movement versus where the German is, as an example.
So talk about mortgages for a second. We saw that bump up in the rate yesterday. At the same time, let's be honest. I remember days when mortgage rates were over 10%, for goodness sakes. We're still at a pretty low rate. At what point does it actually affect your business?
I think it's very accommodative at this point, even at a 150 10-year rate. So we're still seeing a significant amount of people still demonstrating interest. I think you got to keep in mind that we've been in an environment where interest rates have been low on an absolute basis for a really long period of time now. So that hurdle rate that you're describing as to when it makes sense for somebody to refi has dramatically come down from what it was 4, 5, or 6 years ago. So another 25 to 50 basis point movement in that 10-year, and activity will definitely slow down.
Finally, give us a sense of the consolidation in your part of the banking world. We've heard a lot about regional banks, and we've seen some significant consolidation. Do you anticipate more? Are you interested yourself in consolidating, getting bigger, acquiring others?
Look, I think there's wonderful opportunity, especially in our space today. To me, we're like the Goldilocks from a size perspective. The large banks have digital capacities to go after commoditized consumers, and the smaller banks have the ability to really focus on that personal relationship service. There's very few banks that are like Valley from a mid-cap perspective that have the ability to layer on technology while leading with the relationship. And we think that's a unique differentiator. And I think there's going to be a dearth of organizations like us that really have the capacity to service customer. So I'm excited about where the banking is going. I'm excited about the opportunities. Technology is providing an unbelievable opportunity for us today.
Okay, as I say, Ira, that was a really valuable perspective to have. Appreciate your being with us. That's Ira Robbins. He's Valley National Bank CEO. Coming up, we'll discuss the way forward on the stimulus bill with Senator Tina Smith, Democrat of Minnesota. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. The House will take up the stimulus bill later tonight, and then it heads over to the Senate, where the minimum wage part of the bill is already in trouble. We welcome now one of the senators who will be called upon to decide on what gets done. She's Democratic Senator from Minnesota. She's Tina Smith. So welcome, Senator. Great to have you with us. Now, I said it's in trouble because the parliamentarian said you can't really do it on budget reconciliation, which would mean you need the 60 votes to get past the filibuster. But now it looks like there might be a different way around this. Do you think that it's dead or not, the minimum wage?
Well, I don't think it's dead. I think we have to continue to look for ways to get this done. And let's understand what this is about. This is about lifting millions of Americans out of poverty, people who are sometimes today working 2 jobs in order to support their family in states where they're working the minimum wage, as taking care of people through home health care, servers, all of these jobs that are essential, we say, but then we don't create ways for them to make the money that they need to make to be able to support their families. So I think Democrats are going to continue to push on this. And it also is something that is broadly popular and approved of across the country. I mean, everybody is talking about Florida, which Donald Trump won. And they also voted by over 60% to increase the minimum wage. So we're going to keep pushing on it.
Are you concerned at all about job loss? I mean, you've seen the Congressional Budget Office studies which say, on the one hand, we will lift a lot of people out of poverty if we go to $15. On the other hand, we'll lose something like 1.3, 1.4 million jobs.
Well, there's a lot of academic research in this area, and a lot of that research really says that the job loss that you see is really not significant. And in fact, we have the kind of the experiment that is happening in local communities all over this country, including my home city of Minneapolis, that has raised the minimum wage. And what you see is the dramatic impact that it has on raising people's wages. So to me, that's the most important thing, especially right now in the midst of COVID, where this inequality in wages and wealth is getting greater rather than narrowing.
The bill that looks like it will be approved by the House later tonight looks pretty much like it was proposed. Do you expect that bill to make it out of the Senate? I would assume there's going to be some changes made. Are you anticipating that?
Well, as you do know, we have this arcane process in the Senate called reconciliation, which means that we have to do it in a very specific way in order to meet the requirements of this budget reconciliation process. So what'll happen this week in the Senate is we're going to keep on working on it. We're going to identify exactly where what the whole package should look like. I believe it'll end up being very similar to what will pass in the House, but we also have to accommodate the particular rules of the reconciliation process, which allows us to pass a really important bill, a bill that America wants, with a majority vote.
Let's turn to another subject that I know you're very involved in and is of concern to you, which is climate. And two parts of that. Number one, what happened in Texas last week? What happened to natural gas? You're involved in some of what we're seeing with the spikes in natural gas. Give us a sense of what you see and what can be done about it.
Well, I think we all watched the disaster that happened in Texas last week with people losing their power, losing their water. Literally, people lost their lives because of the inability of the Texas electric system to be resilient enough to deal with the weather events that they had there. And then, meanwhile, here in Minnesota, thousands of miles away, the ripple effects hit us when we had dramatic price spikes in natural gas. And just as an example, in Hibbing, Minnesota, a community of about 16,000 people, the home of Bob Dylan, they typically pay about $4 a unit for natural gas. Over the course of 5 days, they paid in the neighborhood of $400+ a unit for natural gas. So that's money in Minnesota that got shipped to the natural gas producers, who I think looks to me like it was price gouging. So we've got to get to the bottom of this, and we have to understand the power, literally, no pun intended, in addressing the resilience in our electric system and the need to move towards a clean energy economy, which is going to help to create jobs. And I'm very excited about that work and what we can do on that when we move to this big infrastructure package coming up next.
Is there going to be the money for that, given how much money it looks like is going to be spent on this stimulus package?
I think there has to be money for this. I mean, our country has been underinvesting in infrastructure, whether it is schools, whether it is the power system, whether it's transportation, whether it's housing. We have been underinvesting in this, underinvesting in the research and development for clean energy is another example for way too long. And we can either lead on this issue or we can follow. And I think that we need to lead.
So talking about clean energy and dealing with the climate, I watched with interest your exchange with Chair Jay Powell of the Federal Reserve this week, where you pressed him on disclosure requirements for companies about the costs of their climate behavior. And he basically said, look, I think it's a really important question, but it's not for the Federal Reserve. You better go talk to the SEC. You're going to have that opportunity with Gary Gensler, the nominee for the head of the SEC, on Tuesday. What are you trying to get out of Mr. Gensler?
Well, I have talked with Gary Gensler about this already, and I think it's a really important point. You know, climate risk is a systemic risk, I think, when it comes to banks. And we need to treat it that way, not like, a one-off weather disaster like a hurricane that we couldn't have anticipated. And what I think we need to do is, with the big financial institutions, is to get to some sort of a standardized way of assessing that risk so that people can compare it across institutions. They can understand what it means, and then they can make decisions based on that. I think that this is going to be a really important step forward. And it gets us to the place where we need to understand that there is is a huge cost, a huge risk in not dealing with climate. And we can actually put a dollar value on that. And people need to know what that is.
Are you confident in the ability to do what you just said? Because you just said it's across industries, across sectors, and very different sorts of operations. Can we have a standard way, one way, in which we can really compare apples and apples?
Well, I think what Jay Powell said when I asked him this question was right, which is that we need to figure out how to do this correctly. We need to be consulting with the industry folks, with people who've done a lot of work and research in how to make this happen. And then we need to be able to develop some way of comparing that risk across sectors. And of course, I start out thinking about the banking institutions that, as I was asking Jay Powell, that the Fed regulates and oversees. And there we can definitely come up with some sort of a standardized metric.
That's true. But do you expect that out of the Fed rather than the SEC?
Well, I think both the Fed and the SEC need to look at this because both of them are regulating organization. The Fed has a regulatory role as well as as an oversight role, as well as its dual mandate role. So that's why I think that question is important to the Fed and, of course, to the SEC as well. Yeah,
critical regulatory role for the Fed as well as the SEC. Thank you so much. It's always great to have you with us, Senator. That's Senator Tina Smith. She's a Democrat from Minnesota. Coming up on Balance of Power, we're going to continue on Bloomberg Radio. In our second hour, we're going to talk with former Republican candidate for president Carly Fiorina about the divisions in her party as former President Trump heads to a CPAC appearance. That's coming up over this weekend. He is reportedly not going to say he's running for president, but he's going to assert his dominance over the party. This is Balance of Power on Bloomberg Television and on radio.